Okay, so imagine this for a second.
Mm-hmm.
You're steering this massive financial battleship, right?
Mm-hmm.
And you're looking at the dashboard, and the signals are just completely mixed. I mean, on one hand, you just hit record revenues.
Which is great.
Great, and you're recruiting new crew financial advisors so fast you can't even print the security badges.
Uh,
But then you look at another dial, and one of your key engines, the deal-making machine, capital markets, it's just completely stalled out.
Stalled is putting it mildly. A profitability drop of nearly 90%. In most boardrooms, that's a full-blown crisis.
Exactly. That's a panic button moment.
Yeah.
But here,
Yeah.
it's somehow all part of the plan. And that's the contradiction we're digging into today. We're doing a deep dive into Raymond James Financial's Q1 2026 earnings. They just dropped on January 28th.
Yep, we've got the call transcript with the CEO, Paul Shakri, and CFO, Butch Warlog. We've got the slide deck, the whole 9 yards.
And our mission really is to unpack how a strategy that seems, kind of boring on the surface.
Oh, very boring. Slow and steady, client first, all that.
Right. How that is actually winning this war for financial talent against some really flashy, really aggressive private equity firms.
It seems like boring is the new exciting.
Boring is winning. I like that. So let's start with the scoreboard, because the numbers themselves are a little confusing.
Yeah, they missed on revenue estimates, but beat on earnings. The market never quite knows what to do with that.
So what are the big numbers we need to anchor on here?
Well, the headline number is $3.74 billion in net revenues.
Yeah.
Now, that is a record for them. It's up 6% year over year. But you have to say, it did technically miss the Wall Street consensus just by a hair, but it wasn't a huge blowout on the top line.
But the profit side of the equation held up.
Better than held up. They hit an adjusted EPS of $2.86. That beat estimates by 3 cents. But the number you really need to look at, the one that tells the story of the business model, is the margin.
The pre-tax margin.
Exactly. They hit their target of a 20% adjusted pre-tax margin.
Okay, let's pause on that because we hear about margins all the time.
Right.
Why is that 20% number so important for Raymond James? What makes it the magic number?
It's magic because of the environment they're in. I mean, think about the headwinds. You've got interest rates falling, which normally hurts a bank. You've got that huge slump in investment banking we just talked about.
Right.
So if you can still pull in 20 cents of profit for every dollar of revenue with all that blowing against you, it just means your machine is incredibly resilient.
The chassis is strong.
That's a good way to put it. Their return on equity, the ROE, was 18%. For a big, diversified firm like this, that's a very, very healthy heartbeat. They're using their capital really efficiently.
So, okay, financially, they're sturdy.
Yeah.
But reading through the transcripts, the thing that really jumped out wasn't the balance sheet.
No.
It was the people. The recruiting numbers they're just massive. I honestly thought it was a typo at first.
This is the aha moment of the report. This is where you shift from just accounting to, actual strategy.
They brought in something like $31 billion in net new assets, NNA, just this quarter.
$31 billion. That's an 8% annualized growth rate. And if you zoom out over the last year, it's almost $69 billion in new assets.
And the $31 billion this quarter, Paul Shukri said that's their second best quarter for that metric ever.
Ever. And you have to remember the seasonality here.
Right, this is their Q1, so it's the end of the calendar year, October, November, December.
Exactly. It's the holidays. Advisors are supposed to be at parties, not moving their entire life's work to a new company. It's usually a dead zone. And somehow, Raymond James is just scooping up billions.
So that's the big question. Why? What's going on? Are they just writing bigger checks than everybody else?
You'd think that's the simple answer, and I'm sure the money has to be competitive. But Shukri was really clear on the call. He argues it's not about the money, it's about psychology.
The psychology of what?
Specifically, the psychology around the private equity model that's kind of taken over the wealth management industry.
Okay, explain that dynamic.
Yeah.
We hear about these roll-up firms all the time.
We do. So
Yeah.
you have these firms backed by private equity. They go around and buy up smaller advisory practices. But here's the catch. Private equity always needs an exit. They need a liquidity event, a sale, an IPO every, say, 3 to 5 years to get their return.
So the ownership is always in flux. But why does the advisor on the ground care? They still have their job, right?
They do, but it's disruptive. Shankri said advisors are getting deal fatigue. I mean, imagine you've spent 20 years building trust with your clients. You don't want to have to explain every 36 months why your firm has a new corporate owner.
It feels like you're just a commodity being traded.
That's it exactly. Shockley called it short-term noise, and that's resonating. Advisors are looking for what he called a forever home.
A forever home.
Yeah, a place that's stable, where they own their book of business, and they're not worried about some big disruption because the parent company needs to cash out.
It's so interesting because stability usually sounds like code for, boring or low growth.
And here, stability is the sales pitch. Stability is the product. And the data backs it up. Their retention of existing advisors is the best it's been since 2014. So people are coming in the front door, and nobody's leaving out the back.
I did notice something new in their expenses. They actually broke out recruiting and retention expenses for the first time. Why do that? Why highlight a cost?
It's all about framing it as an investment. They're telling investors, look, this isn't just overhead. This is us buying growth. Shorkry even compared the production of the advisors they brought in over the last year to doing a massive M&A deal.
But instead of buying a whole company,
You're handpicking the best people, one by one. It's organic growth, but on steroids, and it's a much lower risk way to grow.
okay, so the wealth side is absolutely on fire, but we have to talk about the elephant in the room. Or maybe the sloth, given how slow it's moving. Capital markets.
The weak link. Yeah, no way to sugarcoat this one.
Revenue's down 21% year over year. Pre-tax income, I mean, this number is just wild. It plummeted almost 90% to just $9 million.
It looks really ugly on the page, doesn't it?
90% drop. Is the phone just not ringing?
Well, you have to remember that investment banking is a really lumpy business. It's not recurring. You eat what you kill. And the quarter they were comparing against last year was a huge boom time for M&A, so it was a really tough comp.
Okay, but Shukri kept saying on the call that the pipeline is robust,
Needed dead.
which, you always hear that, right?
Yeah.
Is that just CEO speak for please don't sell our stock?
I mean, there's some of that, sure, but there is truth to the pent-up demand idea. You have buyers who have cash they need to put to work. You have sellers, business owners who have held on for years because the market was so weird.
So everyone wants to dance, but the music hasn't started yet.
The music is starting and starping. He said deals are just taking longer to close, so they're ready, the clients are ready, but you can't force the market to close on your schedule.
Right. It's a waiting game. Okay, let's talk macro. Interest rates, they're down, 125 basis points since November 2024. For most of us, lower rates are good. But for a firm like this, it's complicated.
It is. It's a double-edged sword. On one hand, lower rates hurt the money they make on idle cash and client accounts. That's the cash sweep.
Can you just break down cash sweep for us real quick?
Sure, it's simple. You have cash sitting in your brokerage account, right, from dividends or whatever.
Yep.
The firm sweeps that cash into a bank account and earns interest on it. They pay you a tiny bit, and they keep the spread. When rates fall, that spread shrinks.
And their balances in that program did drop. But Chatri seemed weirdly optimistic about it. Why?
Because you have to ask where that money is going.
Oh.
It's not leaving Raymond James. It's moving from a savings account into the stock market.
So clients are deploying their cash. They're reinvesting.
Correct, which signals client confidence. And while it hurts the bank's interest income today, Raymond James earns advisory fees on those assets tomorrow. So it's short-term pain for long-term gain.
And speaking of the bank,
Yeah.
this was the big surprise for me in the report. While investment banking was getting crushed, Raymond James Bank was the hero of the quarter.
A massive hero. Record pre-tax income. $173 million, up 47% year over year.
How does a bank have a record quarter when interest rates are falling? I thought the margin squeeze would hit them hard.
It all comes down to their secret weapon, which is something called securities-based lending, SBL.
SBL. Okay, how does that work?
It's pretty simple, actually. Say you have a client with a $2 million stock portfolio. They need cash for, I don't know, a vacation home.
Okay.
They could sell their stocks, but then they have to pay capital gains tax. They lose their market position.
You'd kill the golden goose?
Exactly. So instead, they just borrow against the portfolio. The stocks are the collateral. It's like a home equity line of credit, but for your stocks.
And that's growing.
Exploding.
Uh-huh.
SBL balances grew 28% year over year, 10% just in this quarter alone. And it makes total sense, right? As rates dip, borrowing gets cheaper. But for Raymond James, it's this incredibly sticky product.
Sticky how?
Well, if your portfolio is collateral for my loan, you can't just pick up and move your accounts to another firm, right?
Yeah, you'd have to pay off the loan first.
You would. It locks the client right into the ecosystem. It's brilliant.
That is smart.
Yeah.
Okay, let's shift to the future a little bit. AI. Every company talks about AI now. But Raymond James is putting real money behind it. Something like $1.1 billion a year on technology.
That's a huge number. And it gets back to that competitive moat we were talking about. Your small, private equity-backed firm can't spend $1 billion on tech. They just can't.
Shorey had a funny line about that. He said they recruit advisors who only realize after they join how bad their old tech was, like they were working on a DOS prompt.
It's funny because it's so true. So much of finance runs on ancient systems. And Raymond James is trying to leapfrog all of that with this new AI tool they call Ray.
Ray, R-A-I.
Yeah.
Like Raymond.
Yeah.
So what is it? Is this a robo-advisor that's trading stocks for people?
No, and that's a really important distinction. Rai is internal. It's for the advisors and their staff. Think of it like a super smart assistant that can answer operational questions.
So give me an example.
Okay, an advisor needs to do a complex trust transfer. Normally, they'd have to call the support line, wait on hold. Right. Now they just type the question into Rai, and it instantly spits out the procedure, the forms, everything. It's all about efficiency.
So it's not replacing the human, it's automating the drudgery.
It's letting the humans do the human stuff, the consulting, the relationship building, which fits perfectly with their brand.
The power of personal. And that has to be a huge recruiting tool, too.
Oh, absolutely. Come here and spend 20% less time on paperwork. That's a powerful pitch.
No doubt. Okay, let's talk about how they're spending their capital. They're not just building AI, they're buying companies. 2 recent acquisitions.
Yep, Clark Capital and GreensLedge.
Clark Capital first. Asset manager, $46 billion in assets. What's the strategy there?
It's a perfect strategic fit. Clark specializes in things like model portfolios for high net worth clients. It basically gives the Raymond James advisors another premium product to put on the shelf for their wealthiest clients.
And then GreensLedge, a boutique investment bank.
Yeah, and this one is interesting. It's a contrarian move.
Because capital markets is struggling.
Exactly. That division is down 90%. Most firms would be firing people. Raymond James is out there buying talent.
Buying low.
It's a bet that the slump won't last forever. They're bunking up the team so when the market turns, they're ready to go.
And for shareholders, they're also just buying back their own stock, a lot of it.
$400 million in Q1, and they're targeting another $400 million in Q2. And the key is they can easily afford it. They have $2.4 billion in excess capital.
Okay, hold on. You mentioned their Tier 1 leverage ratio is 12.7%. You got to strip away the jargon for us. Why should we care about that number?
Think of it as a financial cushion. It's the ratio of a bank's core capital, the real money it owns, to all its assets. 12.7% is extremely high. It just means they have a fortress balance sheet.
So they can handle a crisis.
They can handle almost anything. And in uncertain times, that's exactly what a risk-averse financial advisor wants to see in their parent company.
So when you put it all together, the recruiting, the bank, the tech spend, all of it offsetting this temporary slump in deal-making. What's the big story?
The story is that the boring strategy is winning. They're using structural, long-term growth in wealth management to power through the cyclical weakness in investment banking.
It's the marathon mindset.
Paul Shutry used that exact phrase. It's a marathon, not a sprint. He basically said they don't care about hitting a recruiting number in one specific quarter. They're looking out 10 years.
It's so refreshing to hear a CEO say that. They're usually obsessed with the next 90 days.
It is. In a world of quarterly capitalism, they're acting like a private partnership. And that stability is becoming their single biggest competitive advantage.
So here's where it gets really interesting for you, the listener. We're in this world that's increasingly dominated by algorithms, by high-frequency trading, by bots like Ray. And yet, here is Raymond James betting over $1 billion a year on the idea that the most valuable asset in finance isn't the code, it's the handshake.
That's the bet.
And the question is, will that bet hold up? As AI gets smarter and smarter, will clients still pay for that personal relationship? Or will the bots eventually come for the advisors too? Raymond James says the human is here to stay.
And right now, $69 billion in new assets says they just might be right.
It's a compelling case. We'll leave you with that thought. Check out the show notes for the earnings deck if you want to dig into the numbers yourself. Thanks for joining us.
You learning?